This is an overview of Economics, Chapter 19, Gross Domestic Product, measuring production, total production, and income. So we're going to learn what GDP is and how it measures total production, why we want to measure it, what real GDP versus nominal, and other measures of total production and income. I did an overview, but it seems there is some confusion on GDP, so I'm going to do this whole chapter here. So, Ford Motor Company feels the effects of the recession. In the spring of 2009, with the U.S. economy suffering its worst downturn since the 1930s, sales of Ford cars and trucks plummeted. By 2011, the economy was slowly recovering from the downturn. Ford's sales were rising. Ford and the automobile industry as a whole were experiencing the effects of what we call a business cycle, which refers to alternating periods of economic expansion and recession. Production and employment increase during expansion and fall during recessions. So what's the best country for you to work in? This is an economics of life question from the book. Suppose that an airline offers you a job after graduation in 2012. The firm has offices in Canada and China. Because you are fluent in English and Mandarin, you choose the country in which you want to live and work. Gross domestic product, or GDP, is a measure of the economy's total production of goods and services. So one factor in your decision might likely be the growth rate for each country. Based on International Monetary Fund's forecasts in 2012, GDP would increase by 2.6% in Canada, but expand by 9.5% in China. See if you can answer these questions by the end of the chapter. What effect do these two very different growth rates have on your decision of where to work and live in, whether you want to work and live in China or Canada? If China's much larger growth rate, does that not necessarily lead you to decide to live in China? Why or why not? Okay, so let's talk about some key phrases here. Microeconomics is the study of how households and firms make choices and how they interact in the markets and how government attempts to influence their choices. Macroeconomics, which is what we're studying, is the study of the economy as a whole, including topics such as inflation, unemployment, and economic growth. The first three chapters are part of both books, and now chapter 19 moves on to macroeconomics. A business cycle is an alternating period of economic expansion and economic recession. Expansion, a period of business cycle in which total production and total employment are increasing. A recession is which total production and total employment are decreasing. Economic growth is the ability of an economy to produce increasing quantities of goods and services. And one of the keys to some of this information is the inflation rate, the percentage of increase in the price level from one year to the next. Gross domestic product, or GDP, is the market value of all final goods and services produced in a country during a period, typically 1 year. And remember, we say all final goods. GDP is measured by using market values, not quantities, because we're talking about value in terms of dollars. Imagine we produced 20 oranges and 10 Ferraris. Those don't have the same value. GDP only includes market value of final goods. A final good or service is purchased by the final user. Intermediary goods or services is a good or service that is an input to another good or service, such as the tire on a truck. To avoid double counting, we do not include value of intermediary goods and services when calculating GDP. GDP includes only current production. So GDP includes only things that would take place during our given time period. So if we produced that previous year, it would have been counted in the previous year's GDP. I'm not so worried about you actually calculating GDP, but this is an example of calculating GDP. So the value in the economy, they produce 100 eye exams at $50 per unit. Textbooks, pizzas, $80 units at $10 per unit. Textbooks are 20 at 100, but they use this paper inside the textbooks. So technically, we wouldn't count this 2,000 sheets of paper at 10 cents. So the total economy would be, the GDP for this year would be $5,000 in eye exams, $800 in pizzas, and $2,000 in textbooks, or $7,800. One of the key important things is to understand the circular flow of measurement in GDP. So, Firms send wages and interest, rent, and profit to households. GDP can be measured by total wages, interest, rents, profits received by households. Households actually send taxes to the government, services and goods to the firms, and savings to the financial system. The savings goes back to the firms, and then the expenditures by gross domestic product on household imports goes to the rest of the world. So, the BEA divides its statistics on GDP into 4 major categories: consumption, investment, government purchases, and net exports. Economists use these categories to understand why GDP fluctuates and to forecast GDP. Personal consumption or expenditures, also known as consumption spending by households on goods and services, not including new houses, because that's not consumption. Expenditures are divided into expenditures on services such as medical care, education, and haircuts, expenditures on non-durable goods such as food and clothing, and expenditures on durable goods such as automobiles and furniture. Gross private domestic investment, or investment, is spending by firms on new factories, office buildings, machineries, and additions to inventories, plus spending by households and firms on new houses. Spending on gross private domestic investment, or simply investment, is divided into 3 categories: business fixed investment, which is spending by firms on new factories, office buildings, and machineries used to produce other goods; residential investment, which is spending by households and firms on new single-family and multifamily houses. Changes in business inventory are also included in investment. Government consumption, or gross investment, or government purchases, is spending by the federal, local, and state governments on goods and services. And then the final category is net exports, which is exports minus imports. This is currently a negative number for the United States because we are importing more than we are exporting. We add exports to expenditures to include all spending on new goods and services domestically produced, and we subtract imports from total expenditures to exclude spending that does not result in this production. A simple equation for GDP is Y, which stands for GDP, equals consumption plus investment plus government purchases plus net exports. So when we're looking at the United States, consumption is 70.5% in 2010. And here's a breakdown of the consumption: durable goods, non-durable goods, and services. As we most know, we're a service-based industry, so the majority of our spending is on services in the United States. Now we're talking about investments, so business fixed investments in plant, property, and equipment, and then residential construction. These are new homes, and then changes in business inventory. And then purchases, federal government, actually the state and local government outspent the federal government in this. And then net exports is actually negative 3%. So it subtracts from GDP because we export 18, these are in billions, 101.84 billion, and imports are more than that. So total GDP is $14,527 billion. So GDP shows several interesting points. Consumer spending on services is greater than the sum of spending on durable and non-durable goods. Business fixed investments is the largest component of investment, and purchases made by state and local governments are greater than that made by federal governments. Imports are also greater than exports, so this is a negative number. Will consumers be spending less? The consumption is a large fraction of GDP in the United States. Consumption is a larger fraction of GDP than other high-income countries or rapidly growing countries such as China. So 70% of our GDP is consumption, whereas in China, it's below 40%. Of course, they're exporting everything here and we're buying it, right? Although it can be good news in the long run for the economy, the determination of the U.S. households cutting back on spending and increasing savings in 2011 may partially explain the slow recovery. Remember, if we're counting growth in the economy by GDP and we start saving money, then we're not spending it. I'm not going to go through total value added method. So Is GDP a good measure of the economy? So things that are not included in GDP are the production in the home. So if I make something for myself and homemakers, and production in the underground economy. The underground economy is the buying and selling of goods and services that is concealed from the government to avoid taxes or regulation or because it's illegal. So all of the drug sales that enter the economy with the money, they're not technically counted in GDP because it's illegal. And other things are when people exchange services with each other and we're not counting that, but they're actually doing something, right? That's not being counted because people are avoiding taxation. So if they've done it and concealed it from the government, then we can't really count it. So why do developing countries have such a large underground economy? In developing countries, underground economy is also referred to as the informal sector, as opposed to the formal sector in which outputs of goods and services are measured. I think about when I go to the cruise ships and I get off and there's all kinds of people on the street selling items. I'm not sure who's in control of that and who's reporting what type of income. Although it might not seem to matter whether the goods and services measured in GDP or unmeasured, a large informal sector can be a sign of government policies that are retarding economic growth. So if you have a significantly high, and we see this as we increase the tax rate, people go underground, people avoid taxation. The informal sector is large in some developing countries because of taxation are high and government regulations are extensive. Some could say that about the United States. Shortcomings as GDP. So we're trying to measure the overall well-being of the country. So is GDP a good measure of that? In some instances, I think you have to combine it with things because these are the things that do not calculate into GDP. The value of leisure is not calculated in GDP. If Americans still work 60 hours a week as they did in 1890, GDP would be much higher than it is. But the well-being of a typical person would be lower because less time available for leisure activities. Next thing. GDP is not adjusted for pollution or other negative effects. For example, in other countries, they do not have the same standards for pollution. And so there's a cost to doing that. So therefore, we don't grow as fast, but we technically have less pollution here. GDP is not adjusted for changes in crime or other social problems. An increase in crime reduces well-being, but it may actually increase GDP if it leads to greater spending on police, security guards, etc. But that's not what we want for our country. GDP measures the size of the pie, but not how it's divided up. GDP may not provide information about how the goods and services are consumed by the typical person. Does war bring prosperity? This is a question they ask in the book. So real GDP increased significantly when we were in a time of war because we were manufacturing and we put all these people to work to manufacture this and we paid service people to be deployed. So technically it does increase GDP, but it may give a misleading indication of prosperity. So what's the difference between real GDP and nominal GDP? Nominal is the final value of goods and services evaluated at today's prices. How do we compare this to 1920? Well, we have to adjust that for inflation. So the best indicator is real GDP, which is adjusted for inflation. It says base year prices, but I think about this. Real GDP is adjusted for inflation. Nominal GDP is not. It's today's prices. One drawback in calculating real GDP using base year prices over time may change relative to each other, distorting GDP estimates and further away from current year or base year. To make calculations of real GDP more accurate, in 1996, they switched to using a chain-weighted price, and they now publish statistics on real GDP in chain dollars. We're not going over how to do this, but holding prices constant, meaning that the purchasing power of the dollar remains the same from one year to the next. When inflation happens, you can't buy the same thing with the dollar. So therefore, you can buy less goods with your dollar if you have inflation. I'm not going to go over how to calculate real GDP in this. I'm not going over the GDP deflator, so skip through this. I am going over other methods. So national income accounting refers to the method that DEA uses to track total production and total income in the economy. This is the statistics tables containing the information are called the National Income and Product Accounts, or NIPA tables. So other ways that we could measure instead of GDP, which is the most common that we hear, is gross national product. Gross national product, or GNP, is the value of the final goods and services produced by residents of the United States, even if that production takes place outside of the United States. And national income is calculated as GDP minus consumption of fixed capital or depreciation. Personal income is income received by households. To calculate personal income, we subtract the earnings that corporations retain rather than pay to shareholders in the form of dividends. I really need you to know GNP. So that GNP is the value of the final goods and services produced by residents of the United States, even if we did not produce that even if we produced that outside of the United States. Disposable income. This is a big conversation for people. Disposable income is equal to the personal income minus personal tax payments and is the best measure of income by households that they have actually available to spend. Okay. So GDP was 14,527. GNP is 14,716. And national income, personal income, and disposable income. So this is how much we actually had to spend personally. We can measure GDP in terms of total expenditures or total income. 55% of it is total income. Taxes, depreciation, and statistical discrepancies represent 21%. I'm not so interested in that, you know this. GDP is calculated as the sum of all income payments to households, sometimes referred as gross domestic income. So at the beginning of the chapter, we posed two questions. What effect should China and Canada's very different growth rates have on your GDP decision on GDP have on your decision to work and live in one country over another? And if China's growth rate is higher, does that necessarily lead you to decide to work in China? Why or why not? So things that we might consider are pollution, leisure time, things like that might come into play that's not included in GDP, right? And that's the end of the overview of chapter 19.